So let's begin. We're going to go through a live market analysis using supply and demand. We're going to go into what supply and demand is, and we're going to actually look at the live markets. So a quick disclaimer before we begin. All comments made by myself are for educational purposes only, and you all know there's a high degree of risk involved in all types of trading. This is what you should do. You should turn off all distractions and focus on what we're going to cover today. We're going to start very simple, just for those people who are here as beginners. So I'm always assuming that there are some beginners in the audience. And even for those people that are a bit more experienced at trading, sometimes it's good to go back to first principles. Sometimes you might have the first principles down incorrectly, so relearning them might shed light as to maybe some misunderstanding we may have. Renee already gave me introduction, so we can move on from there. And as I start all my webinars this way, trading is a business. So treat it as a business. Hobbies cost money, businesses make money. You want to run your trading from day one as a business. You want to prepare, you want to have a plan, you want to follow that plan. You want to know exactly what you're doing. If you're just trading randomly and randomly stabbing the market in with the hope of making money, or the next trade's going to make back what you lost on the previous trade, that's not the way to do it. You have to have a structure in which you operate, just like any business. As a trader, there is a structure, there is a methodology, there is a process you need to go through. And that's what I teach in some of my training, how to actually set that up, how to run a trading business professionally. So here's our agenda for now. I'm going to give a brief introduction to chart reading. We're going to ask the question, why am I always wrong? Why is it sometimes very frustrating for traders? I remember if I go back to my beginning days, I always seem to be buying just before it went down or selling just before it went up. And I'm like, what's going on here? And I'm sure that's happening, to some of you as well. You always seem to be on the wrong side of the market, and why. So we're going to go through that. Then we're going to go into supply and demand, the basics, what it is and why you should be concerned about it and why you should need to know it. And then we're going to take that understanding, we're going to go through one thing that will help you tremendously find areas of supply and demand on the charts. And we're going to do that. And then we're going to take that understanding into the live markets. And we're going to analyze primarily Forex, futures, maybe some commodities and stocks. So maybe think about any US stocks that you want me to have a look at. We can do that. And I'll go through the main majors, the Forex pairs. I'll go through oil, gold, and we'll look at the E-minis. And yeah, and then we'll open up at the end for questions and answers. I also have an offer if you want to take this further at the end. Okay, so we're going to learn some very important things that you need to know. These are foundations. Remember, our actions follow our belief system. If our belief system is inaccurate, then our actions won't produce the results that we desire with our trading. We need to make sure that our foundations are built strong and correctly before we go forward. Okay, so let's begin. So first things first, as a trader, especially a technical trader, you need to understand how to read the charts. Even if you're a fundamental trader, understanding how to read the charts is very important, because even as a fundamental trader, the timing of entries, they don't tell you where to enter. They might tell you some things underpriced or overpriced, but they won't tell you exactly the best areas in the chart to enter or the best timing. So over here you see a chart, candlestick chart. Most people nowadays use candlestick charts, even though there are other forms of charts. So the first thing you need to do is learn how to read the markets like a professional, like a pro. And that's understanding how to read price action without any indicators. I know I have a CCI on here, but you don't need to do that. You just need to understand how to read these candlesticks over here. So we use Japanese candlestick charts, and we're going to go through very quickly Japanese candlestick basics for all those beginners out there, and it will be a refresher. We're going to go through pretty quickly, so hold on. Japanese candlesticks look somewhat like this, and they represent four prices: the open, the close, the high, and the low. If price closed above the open for the time period, usually it's green. You can use anything that represents closing above the open for that time period. It could be any color you desire, but most people use green and red. And they represent a period of time. If they're on a 5-minute chart, that's what happened during 5 minutes of time. If they happened on a daily chart, it's what happened during 1 day or 1 week or 1 month. So we'll say this is on the hourly chart. So this is the open of that of 1 hour. An hour later, the market closed here, and this is the high and the low. This is called the body. These are called wicks or candles or shadows, whatever you want. And on the other side, here's the open. If it closed below the open for the period, it's red, or whatever color you use to portray that, and the high and the low. If the low was the same as the close, there's no wick. Okay, so everyone understands that. Just type a 2 in the room if this is the first time you've ever heard this. I'm going to have a look and see if I can see. I have to open up the questions, yeah? Okay, now I can see what's going on here. So just type a 2 in the room. Let me see. Okay. Okay, guys, just type a 2 in the room if this is completely new to you, or type a 1 if you know this inside out. And then we'll move on. Okay, so let's move on. Here's two very important candlesticks you need to learn. Now, again, most people are taught that this is a bullish candlestick. And does anyone know what it's called? Type in the room if you know what this candlestick is called. Even if you've heard this before, type in the room what this is called. What's this candlestick called? And we're taught generally that this represents, it's a bullish candlestick, but not always. And again, when you get deeper into your understanding of candlesticks, sometimes this is actually a bearish candlestick, depending on where it's happening and what the context is. This is called a hammer. Okay, it looks like a hammer. That's right, Michael. Well done. And the one on the right, does anyone know what that one's called? What's this candlestick on the right called? Generally, it's a bearish candlestick if it's happening in the context potentially of an uptrend or in a supply area in the charts. Yep, that's right, Michael. That's called a shooting star. Okay. Now we're generally taught, as we said, that this candlestick on the left, the hammer, is a bullish candlestick. Yes, it is if you're in an uptrend and it's after a number of bars down to a demand area or a support area on the chart, and you see a candlestick like that, it may mean that the market's about to go higher. But it also means in other contexts that the market's going to go lower. So you have to understand the difference. So let's ask the question now. Why am I always wrong? What is it that gives beginning traders or traders at the beginning of their journey a sense of whatever I do, I'm always wrong? So let's have a look at the scenario here. The market looks like this. And you're taught, to read a trend. So the market's going up and up and up, and you say, let's take my first trade. Market's going up and I'm an uptrend, everything great, let's buy. So I take my first trade over here. This represents my first buy in the market over here. And I'm feeling great about it, my first trade ever, and the market goes up and I'm doing really, really well. And I'm phoning my friends and saying, this is really easy, I'm making money already, my first trade. And while you're on the phone to your friends, the market takes a dip to the downside and you don't have a stop in place and it keeps going down and down and down and you're kind of underwater, losing money. You look at your P&L and it's down like a couple of $1,000s and you think, uh-oh. And just before you can't take it anymore, you're like, I gotta get out. And you take your first loss and you're not feeling very good about yourself. And then you think, I've got the direction wrong. It's going down now. Let me sell. And you sell and you take a bigger size because you want to make back the money you just lost on the first trade. You're trading with emotion now. And you want to get back. The market just took my money away from me. That's what you're thinking, and you want to get back at it. Again, that's not the right way to think, but this is how many beginning traders think. And it starts to go in your favor, and you're making back part of what you lost, and all of a sudden the market turns around to the upside and you're in so much pain now, and you're wiping more of your account off and you just close the trade over here. And then you do it again. You're like, it must be going up. So you buy again, and all of a sudden the market turns around and it goes down, 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 and you're like, gotta get out. And you sell over here for another loss. And then you take a step back and you think, I got it now. I really got it. Because what was happening? I was buying up here and I should be selling up here, shouldn't I? And I was selling down here and I should be buying. I got it backwards. That's what you think to yourself, yeah? So what happens is the market comes up to this area again, and you think, I got it now. You know, if I was buying here and it was wrong, and I was selling down here and it was wrong, I'm gonna sell here now. And you take a trade with huge size just to make back. You've nailed it. You understand the market now. Of course it's going to go down. And you take a sell trade over here, and the market what? It goes up, and you finally sell over here for a big loss, and you start scratching your head. You're really in a bad mood now because you got really emotional over it, and you've just lost 4 trades in a row and wiped out half your account. This is what happens to many beginning traders, and you think, what on earth is going on? I learned about trends. I was buying in an uptrend. I was selling in a downtrend. Then I learned about supply and demand, and I was selling and supplying. It just nothing works. What's going on? Just type a yes in the room if that's ever happened to you before, and you can relate to what I'm talking about here. Just type a yes in the room if this is you or was you at some point in your development as a trader. This was certainly me when I first began. Yeah. So what you do now is, yeah, you bet, Milo. Yes, exactly. Yes, I'm Glenn. Yes. Used to be Michael. Yeah. Those days were a long time ago for me. I started trading so about 12 years ago now, full time. Yeah. So what you do is you start to identify zones over here called demand and supply. And then, you know, the books tell you the more times you go back to supply zones over here, the stronger they get. But in reality, that's not always the case. So you have to learn when it is and when it's not. When is it likely to go down here and when is it likely to break it? And again, that's what you need to learn when you start getting in depth with supply and demand. So let's move over to supply and demand now. What is supply and demand? And why is that so important? Well, let me tell you a little story. When I first started trading, I was trading US stocks on the New York Stock Exchange. And I was trading a specialist system of trading where we were to identify based on the level 2 and the time in sales. And the specialist open book, what the specialist was doing. Remember, the specialist was the ultimate day trader and they see most of the order flow. So if you could identify what the specialist was doing by identifying his patterns of action or her patterns of action on the level 2 and time and sales, then you'd be a buyer if you could see they're buying. If sometimes there was a bid and the print went off one higher, so this could be the specialist buying, and various other methods that we learned. But the problem was when the New York Stock Exchange went hybrid, it was no longer all human, it was part computer, part human. The system of trading that we were taught and that we traded successfully at the beginning didn't work anymore. So it was like back to the drawing board. This doesn't work anymore. So what you have to do in that situation is you want to learn a methodology of trading that stands the test of time. That once you learn it and you perfect it, you can carry on doing it for the rest of your life and you don't need to keep changing. So what is that? Supply and demand. And how does that affect markets? Well, everyone knows when the prices move higher when there's more demand than supply, and prices move lower when there's more supply than demand. No one can deny that. And the other mode of action in the market is prices will move sideways when there's an equilibrium between supply and demand. So let me ask you guys a question. What moves markets? What moves markets? Do you want to type in the room? What moves markets? Is it the news that moves markets? The FOMC? Is it earnings that move stocks? Is it upgrades and downgrades? What is it? So guess what? Markets are moved by the forces of supply and demand. What causes imbalances between supply and demand? Well, it could be many things, but if you can see that in the market, then it doesn't matter what's causing it. And guess what? And this is the real magic of this. Once you learn this will never change. Supply and demand will never change. It's been around since the beginning of time, and it's not going anywhere. Prices will always rise when there's more willing buyers and sellers in the market, People think erroneously markets are rising because there's more buying going on than selling. How can that be? Have you ever, how can someone buy more than what's being sold? Or how can someone sell more than people are buying? You go to a shop and they sold, 10 computers. So how many computers were bought? 10 computers, exactly the same number of buys and sells. When you look at the time and sales, it's the actual transaction that took place is an agreement between buyer and seller on a price at a certain time. So buyers are matched with sellers. There's always the same number of buyers and sellers once an execution has taken place. But what we really mean is more willing buyers and sellers. If there's more willing buyers at certain price levels than there are sellers, prices will rise once that supply is absorbed and move up to the next price level. For example, if you go to a shop and you're looking, to buy something, and it says the first 100 are for $100. So if you're number 101 in the queue, you're going to have to pay the next price up, which is 150. You want to buy it? Well, there's no more left at that price. That's what supply and demand is. There's demand, but no more left at a certain price. Then you'll have to pay, if you want it, the higher price. No choice. There's no more supply at that last level. And guess what? That's the way the world works. The markets are no different, and that will never change. So what is your job as a trader? Your job as a trader, part of your job is to identify where supply and demand is on the chart. So we have a chart that looks something like that. And if you can identify where there's more willing buyers and sellers in the market, for example, you may identify a demand zone here because prices came down and rose here. So there must be more willing buyers down at this level than sellers. Otherwise, prices could never rise. Remember the laws? If there's more demand than supply, prices go higher. So it must be that there's more supply than demand than supply. And up here, if prices dropped, you type it in the room. What does that tell you about this price level over here? It tells you that there's more supply than demand. Now, again, a lot of books may say on the supply and demand, or support and resistance as they call it, that you join peaks and troughs. Remember, supply and demand are not single prices, and they're not one price. They're not one price. There are zones in the market. Professional traders do not buy at one price. They buy in zones and they sell in zones. If they're buying and selling for clients, then the client may say, buy me between this area and this area and sell me between this area and this area. And those orders generally stay in the market until they're filled for the clients, because that's what the client wants. If you can identify where that is on the charts, then you can identify where markets are likely to turn. Again, it's not as simple as that, but this is part of the story, part of the picture of understanding price movement, price action in the market. And it's based on an understanding of supply and demand that you can believe in, that you can trust. It's not just red light, sell, green light, buy, and you've got no idea what's going on. If you want to trade with confidence and without having fear, you better make sure that the system that you're trading, you trust it. And how can you trust it if you don't understand how it works? If you can understand this system of trading based on supply and demand, you can trust it, and therefore you can trade with confidence. Trading with confidence means fear goes out the window, and there's various, and that means you can trade much better. Fear is the enemy of a trader because it gets you to act emotionally. And when you're acting emotionally, you're not going to do the right things in the market. You're going to be in the market, and get out of a trade too soon because you're afraid that you may lose your profit. Or you might get out of a trade too soon because you're afraid you're going to lose more. And then it turns around and goes to your target, and you stand on the sidelines watching it and say, if only I would have just stayed in the trade. What got you out? So how do you identify high turning points in the market? So let's reveal what goes into that. Who wants to look at the live markets now and start to see how to identify those high probability turning points? We're going to look into the live market now. We're going to do a live market analysis. That's a little bit of an introduction. Let's take that to the live market now. Okay. I'm going to pull up my live charts, and Let's pull this over. Oops. Okay. Okay. Okay, so let's have a look at this. Here's a dollar. Now, I'll put a video out on my YouTube channel. You can get that from my website every single week on Sunday, which tells you what's likely to happen, what the probabilities are in the dollar. And you can use that and go back through all those videos to gain a tremendous understanding of how to read the market. And you can see we've got areas like this. Let's just pull this up on the bigger time frame. Why did price drop from this area? And why is price stopping over here and maybe bounce? Why did price go down here for the past 5 months? Yeah. And why may we bounce from this area? Now, if you take a look at the weekly chart here, you can see, and this is what you need to identify. For example, here's a supply level. What we're looking for, and this is one of the things that you should look for, is big, solid candlesticks moving out of areas. For example, here you see there's two almost solid candlesticks, a little bit of a wick over here coming down. So this marks a supply zone. Over here, we have one solid candlestick coming down. Over here, we've got a candlestick, 1, 2, 3, 4 candlesticks coming up. This marks a demand zone over here. Okay, so you can see what's happening. The market dropped down to this area. And again, I don't put these zones on, you know, after it's already happened. They're there, like this one, before the market actually gets there. And you can see the market's actually turning around here to the upside. How can you see that as well? So you can see also we have demand over here. And you can see there's a big bar up here. And this is a pullback into this area. And you can see what's happened. We pull back. And from a trend perspective, we made a higher, kind of a higher low. We made a pivot here. And now we've made a higher high, which puts us kind of bullish for the time being. But we need to take out the top of this bar for us to go higher, which is why we may have some issue. Now, what's happening here? We have other zones over here, and I have them on my other chart, that these charts I only draw on the monthly, the weekly, and the daily. But if I pull up my other chart, you can see over here, I have it on my other screen. See this? Because I have 3 screens here. On one of my screens, I keep the dollar all the time so I can see what's happening. You can see these are marked out on the 4-hour over here. Now, why is the market, why did I pick this zone? And this was here beforehand. Watch this. See this? This is a rally base drop. Look at the size of this bar to the downside. You think the market's going to go straight through there? Big bar up into this area. Isn't this a great place to be a seller, at least initially? Now, how far is it going to go down? That's a different question, but you don't want to be a buyer after a move up into an area where you know there's more supply than demand. By this, see the big bar? Okay, does everyone see that? Just type a yes in the room if you see that. So this is what you need to start doing to identify areas or turning points on the market. This is a turning point. The market was going up and whoop, turned to the downside. And you can see the same thing here on a 1-hour chart. Who's buying up here? That's greed. Who buys greed? Yeah, you want to be buying down here and selling up there, at least initially. Yeah. And you see how the market, there's also a big bar down here. You see how we staggered here? We went once and then twice, and then kind of we broke it here. So you know I'm likely to go higher. Okay, this is a dollar. So let me put this back onto my other screen. Okay, let's move down now to the euro. And let's see the same thing happening on the euro and the different areas that we have. Okay, so we see zones here as well for here. That here, for example, we have a big bar to the downside. What happens when the market comes up close to this area again? We sell off. You see that? And also we make potentially here, this is, you know, may come down lower. Why is this stopping over here? Well, if we make this smaller, you can see this is demand. See the big bar up? When it comes back down to this area, how do I know it's going to stop there? Well, this is demand and we go up. How do I know it's likely to go down? Well, that's a different question for another time. But watch this, big bar down from this area. This was demand became supply. Look what happens when we hit this area again. Start to go. Now this is a big move down. This is a monthly chart on a smaller time frame, and you can see that. So knowing when to get in and when to get out and how to manage risk, those are other questions, but how to identify these zones ahead of time. You see, I have zones ahead of time identified when the markets get there. Let's look at the pound quickly. Now, again, if you want to type in the room any stocks, we can look at those and analyze those. But this is another thing. Now, this is also demand. You see this level where we stopped today. This is demand. Notice the big solid bars coming out from this area. Once you understand how to read the market here, you should be on the short side today, and the short trade today was taking it from here down to here. If anyone took those trades, the entry was here, and this was a day trade. Entry here off the UK open, 100 pip move down to here, roundabout. Yeah, pretty much a bit more than 100, but if you got 100 with around a 20 pip, 5-to-1 trade. Okay, there's a trade. And why is it stopping here? Well, we just hit demand. We're in the demand zone here on a daily chart. Okay, and also on a 4-hour chart. Look, big bar up, although we've been back here once before, but there's still demand here because there's a big bar out of this area. Okay, so the market's stopping. It may go lower, but you don't want to sell after a move down, not the first time into that area. You have to wait for a bounce to get on board if you want to continue potentially the move to the downside. Let's have a look at the Australian dollar. Okay, same story here. Why is the price stopping here? Why is the price stopping here? So let's take a look. Let's open it up. Again, these lines are there beforehand. Look left. Here's an area of supply. Let's zoom in on that. Why did price? Look at this. A straight run to the downside. So when, again, these lines are there beforehand. So when price comes up here, look what happens. It retreats. This is a very, very big move to the downside. If you were to get the trade over here, it's about 0.806, call it 0.805, down to 78. It's about 250 pips. Yeah, 250 pip move to the downside from here. Why? Supply. First time back. What happens to the trend? The trend changes here. It's no longer in an uptrend. We were uptrending before. We changed the uptrend if you want more confirmation, and off we go. Why are we stopping here today? Big bar up. This is demand. Yeah, and look what's happening on the lower time frames. We're stalling. Yeah, and you can see we get a big push up. Why? Because that's what demand looks like. Is everyone following? Let's have a look. We'll go through a few more things. Let's look at gold. Let's look at gold. Same thing. Again, these lines in our trading room, we put these lines on. You know, every Sunday we prepare the week ahead. We put these lines on. These are lines from Sunday, and every day we prepare half an hour before the US market open. The Forex market is 8 a.m. Eastern time. So we start preparing at 7:30 every day, a plan of what we're doing. We go through the markets that we trade, and we come up with a plan, and then we take the trades based on them as they happen. So you can see we're basically sideways moving market over here in gold. Yeah, and you can see this here on the monthly chart. But again, why did the market stop here and turn? This is supply, solid bars to the downside pretty much. Yeah, there's a solid bar from here to here until we get the tail. Yeah, so when we move up to this area, look what happens. The market turns to the downside. Okay, this is probably a pullback, and we may go higher or not, as the case may be. But, you know, you can actually take trades based on that. The trend changes up here on a smaller time frame and actually starts going into a downtrend. There. So that's gold. Let's see if we have any. Let's have a look at the E-minis. Again, you can make it complicated if you want, but in my experience, you want to make it simple as possible. And again, there's many smoke screens out there. There's many companies out there that are making trading very complicated. It's not. It's price moving up or down. Learn to read price. Every indicator is based somewhat on price, as far as I know. Unless there's a new indicator out there that I don't know about. But I've been through all that. I used to have charts with so many different indicators, and it was very confusing. Some said buy, some said sell. What did I do? I used to go to my, trading coaches or whatever, and I said, well, I've got all these indicators on. These ones say buy, these ones say sell. So what should I do? Should I take, the majority, if two of them say buy and one of them say sell, I'll buy, and then it goes down. Which one? And maybe I'll weight them, and it gets very complicated. Like, how do I do it? And you've got so many indicators on your chart that, guess what? You can't even read the price anymore. I've seen charts with so many moving averages and so many lines on it that you can't even see the price. Price is king in the market. If you can read price directly, why put a pair of glasses on and look at it through lenses? Look at it directly. It won't lie. Price is the truth of the footprints of money. If you know where the market's, what's happening in the market, you can trade with confidence once you know how to read it. A bit like a piece of music. The charts are music for the professional trader once you know how to read them. And understanding, different price structures and will help you. Now, let's have a look at this. This is very interesting. Why did the market stop here and actually go to the upside? Because guess what? This was marked out beforehand. This is demand. Big bar up, we're in an uptrend. So when you're going to move down to demand in an uptrend, what do? You buy. So what happens there? Don't try and sell this, down here. You think, oh, big bar down, let's sell. And look what happens to you. No, no, no. You don't need to do that. That's not the right way to do it. Okay, I'm looking to see if there's any other markets you want me to look at. So is everyone following so far? Let's have a look at, I don't know if we looked at the Swissy, the dollar Swiss. And you'll see the same thing every market. It makes no difference what the market is, every market. We went down, yeah, and we bounced back. Why did we stop here? Why did we start selling off up here when we hit this area? Today, yeah? Why did we go up twice and move down? I mean, again, you could take trades of this. If it's 97.60 down to, I mean, you could get maybe a 60 pip move, but a 50 pip move. Who wouldn't be happy with a 50 pip move every day? Do it twice. This is a bit less, maybe about a 30 pip move, but the first time when price hits back into this area, this is supply, big bar down, same thing. Is everyone following? So again, this is part of what we teach, or I teach our traders, how to read the market. This is part one, learning how to read supply and demand. And one of the keys, the big takeaways from today, is understanding how to identify. So look for the big bars on the market. For example, big bar down, that's institutional, sellers up here. So when the market comes back up here once and twice, look what happens. Knowing this and knowing other things, for example, this made a lower low and that's a lower high. And then we made a higher low, but we didn't make a higher high, so we failed. The market fails to do what you expect. The market speaks its loudest when it fails to do what you expect it to do and does something the opposite. That's telling you something. You want to look at the euro dollar? Yes. TJ will look at the euro dollar. Again, euro dollar, this you can see again, why are we stopping here? We went through this, we're stopping here because this is demand. Why are we starting to bounce here? Demand. How do you identify that? Big bars up, big move up. We made new highs from here. Who can move the market like that? Not me and not you, unless you're a big institutional trader with a lot of buying power. You need to have a lot of money, especially in the Forex market, which is one of the most liquid markets in the world, to be able to move the market like this. I mean, this is a big move, say around 1.28 to 1.3, almost 3.1. It's a 300 pip move. Can you do that? If you put your order in to buy, say, $100,000 or $200,000 worth of pound, can you move the market? Would it make a dent? Probably not, unless you're trading at a very illiquid time when there's nothing happening, or there's no one trading. Okay, so what you need to start doing is to start looking at the market. Here you see, we've got these areas identified ahead of time. You see those big bars down. The market hasn't got there yet, But when it does, well, I mean, again, you have to put it in context of what the market's doing. We've got those zones already marked on the market. Now you see this week, you can see it here. If we look on the pound here, and you can see here's an area marked. Market dropped from here. What happened the first time and the second time back there? We dropped again. And then we broke this area. You see that? Knowing these areas ahead of time. Again, I don't put these lines on afterwards. They're there beforehand, just like this one is. If the market jumped up here or up here, I'm ready and waiting for it. And that's the job of a professional trader. If you, now this may change the way that you're thinking about the market. Most people go to the market, and look at the charts, and they project what they want onto the charts. What you need to do is clear your mind, look at the charts for what they are without having any preconceived ideas, and let the market speak to you and tell you what it's doing. Listen to the market. The market will tell you if you know how to listen. If you're closed and you project yourself on the market, you won't see the market for what it is. You'll see what you want to see in the market to support your theories of what you think should happen based on what you think. And it's a very frustrating way of trading like that. If you let the market come to you on your terms and conditions, once you know what they are, let the market come to you when you know what the probabilities are, and then strike. So let's move now to, again, let me show you how, if you want to take this further, how you can actually do that. And then we'll open up to questions and answers. So now you've seen a simple and powerful approach to reading the market using supply and demand. Again, there's more that goes into that, and that's what I'm going to cover now. And if it's something that you're interested in taking further, I'll show you how, okay? And again, I've seen many different ways of trading. This is by far the most powerful and probably the best way out there of reading the market with complete confidence. So let's take it a step further and learn how to do it yourself. You want to learn how to do this? So let me share with you how you can actually do this. So I have a training, how to read the trend professionally, how to read the market professionally. And this course is designed to help you read the market like a pro. And let me tell you what it entails. The first part of the course, again, is to teach you how to read the trend. Now, this is learning how to read the trend based on pivot analysis. It's not based on, most people may look at the market and say, oh, it's in an uptrend. But the always question I'll ask them, and I'll ask you is, where did the uptrend begin? And if I'm in an uptrend, when does it end? What do I need to see to make it end? Now, most people won't be able to tell you that. I guarantee you, go and ask people out there who are educators or think they're educated about trading, ask them what trends the market in, and ask them to show you exactly when the uptrend began or begins and when it ends. If they can't tell you, then they don't know how to read the trend. You have to know, no matter how you're reading the trend, we read it based on price alone, based on candlesticks. When the trend begins, you have to know exactly when that happens and when it ends. When you're trendless, the market can be in 3 trends, but sometimes it's no trend. When did it could be ending the uptrend. And so what trend's it in? Well, it's no trend at the moment. It just broke the uptrend. Where did that happen? In a supply area. Wow, that's great. So what are the odds now? I'm in a downtrend on a bigger time frame. Oh, I think I'm going to go down now. Is that a good place? I'm in the right location. I'm in supply. The trend ended. So this is what I mean. You need to know how to read the trend. That's stage 1. What you need on top of that, or as well as that, part 2, is learning how to read supply and demand. You have to identify all the different types of supply and demand. There's 10 different types of supply and demand in the market, and you have to understand how to rate supply and demand. When is it likely to break that supply or break that demand, and when is it not? What are the odds? Yeah. So there's a number of sessions that go through that. Okay. And finally, isn't it a good thing to understand what the current price direction is in the market? For example, I'll give you an example to understand this. If you're in a building and you want to take the lift from the 10th floor to the 15th floor, and you're waiting on the 10th floor, and the lift comes to the floor, and the arrow is pointing down, do you get in? Just type in the room, yes or no. Do you get in? You want to go up. The arrow's pointing down. Do you get in the lift? No, you don't, because it's going the wrong direction. So what you need to do, for example, you can be in an uptrend, but the current direction is going down. It's in a pullback. You want to get in? Are you going to get in now? Or are you going to wait till the direction changes to the upside? And how do you identify when there's a direction change? It's easy when you're waiting for a lift. Guess what? The arrow goes from red down to green up, or the arrow turns to the upside, and you get into the lift and it goes straight to the floor you want. So this is exactly the same with understanding how to read price. Do you know how to do that? Do you know when the direction changes? Wouldn't that be a great place to get in? You're in an uptrend, you went down into a demand zone, which is a great location for you to buy in an uptrend. The trend changed on the smaller time frame from down to, I'm no longer in a downtrend. The downtrend broke, you're in demand, and guess what? The direction changed to up. Isn't that a great place and location and scenario to actually buy in and do that? Wouldn't you make money most of the time if you did that? So that's what this is. And guess what? Doing it on multiple time frames. So this is my approach to, again, there's nothing new here, so to say, but it's just how I put it together of how to read the market. It's a three-pronged approach. Remember, if you take a table or a chair and put two legs, it's not very stable. If you have three legs, it gives stability, it can stand. This is what this approach is. It's a three-pronged approach to understanding. Now, again, you could apply just one of these by itself, but put all three together, like I showed you, it's very powerful and gives you very high probability scenarios in the market that you can trade. Now, so this is what this training involves. Now let me show you what people are saying about this training. This is Marcus from Norway. Simon's probably one of the best coaches out there with a heartfelt passion for coaching and a real understanding of how the market works. He helps you view everything in a new way. The way he teaches is also really good. And he goes through it until you understand. I can honestly say that I've gotten more out of this training than I expected. Thanks a lot, Simon. And Yangos from Cyprus, I'm a newbie in the stock market. I had no experience or confidence at all. Began trading by watching videos and joining brokers because I needed to start from somewhere. But it all looked like a giant mountain to me until I was lucky enough to meet Simon. I really struggle with trusting people, but his integrity is like no other. I trusted him, and just some weeks later, I can feel that I can make magic happen. When everybody else is telling you all the wrong things, Simon stands out from the crowd and tells you where you should really focus in order to become a successful trader. It's been a real pleasure being trained by you, Simon. Yangos is in the trading room with us daily. He trades with us live daily. His first trade was a winning trade, I believe, and he actually made 2 times his risk. The next trade he lost, but he was fine with that. And over 2 trades, he was still up 1R, 1 time his risk. So that's how he started out trading. And feeling confident, even taking a loss. It didn't bother him at all to take a losing trade. How many of you get really frustrated when you lose money on a trade? Again, that's one thing that we have to deal with as traders. 2 things we find very difficult. We can't stand losing money, and we don't like being wrong. And as a trader, you have to deal with that, because when you're wrong, you lose money. But we have to change the way we look at trading. Losing is part of a winning system. We have to learn how to lose the correct way, the professional way. It's impossible to make money on every single trade. So once you have a positive expectancy, that means that statistically speaking, you will make money over time. Then losing trades are really part of a winning system, and you're not too fazed by them anymore. How many beginning traders understand that? So let me tell you what you'll be able to do with this knowledge. You'll be able to read any market, Forex, futures, and stocks, just like we looked at now. You'll be able to develop your own trading strategies. What I do different to everyone else in the industry, I don't teach you a strategy. I give you a framework. You can derive from that any strategy that you want within the framework that gives you an edge. You might want to trade on the bigger timeframes or the smaller timeframes. You might be a scalper. You might be a swing trader. Again, it doesn't matter. It's down to you to develop your own trading strategy. And that's what I help every one of my traders do. So that's pretty powerful. Once you know the process you go through, you can develop your own strategies yourself, and you'll be the expert in that because no one else is doing it exactly like that. You'll learn about managing your risk. And guess what? This is a big one. Correctly placing your stops. Most people think that a stop is to stop you losing money. That's not true. Because if you place your stop in the wrong place, you will lose money and you may not gain money. If you put it in the wrong place or too tight or not, you'll get stopped out and the market will carry on to your target without you. So what did the stop do? Did it stop you losing money? No, it actually caused you to lose money. The exact opposite of what you want. So people think erroneously that stops are there to stop you losing money. That's not true. A stop should be placed in an area on the chart where if it's hit, it means your original trading idea is no longer valid. Get me out of the trade. Position sizing is what you should use to limit your risk. Position sizing. The stop has got nothing to do with position sizing. You have to position size once you know where your stop is, obviously. But pick your stop, nothing to do with the position. Most people think, I've got to put my stop closer, but otherwise I can't get enough reward for my risk. If I put it further away, well, guess what? If you put it further away and there's not enough reward for your risk, don't take the trade. So you'll learn how to correctly place your stops once you know how to read the market. You'll trade with the odds in your favor, even if it doesn't always go. Remember, it's odds. Something can be right 70% of the time, 60% of the time. That means you're going to have losing trades. If you were right 70% of the time, 30 out of 100 trades are not going to work, are going to actually hit your stop, okay? And here's the big one. You'll learn how to trade with confidence, without fear. How many of you, I go back to my first trade, I remember very well. I took my first trade and I was shaking. I take trades now with confidence. I don't shake anymore. I'm not nervous. And it doesn't matter if the trade stops out or not. If I followed my trading plan and kept to the rules, that's a good trade, whether it made me money or not. And you'll learn much, much more. So this is what Gerard says. From day one, I was impressed with the level of training I received and the way it was delivered as well. You came down to my level and explained things in simple terms that I can relate to and clearly understand. The wealth of information contained in your trading is unbelievable and outstanding. When you said that I will be amazed at the training, everyone that takes training is. I said to myself, what else can he say since he's the one delivering the training? To be honest, I was blown away by what I was receiving just in part one of our training session. I cannot wait to start the rest of the training. This was talking about learning to read the trend. That's part one. I'm grateful that I met you at the beginning of my journey into trading. I lost some money before meeting you. I would have lost even more had I not got an education and training from you to put the odds in my favor. So this is what you're going to get in the course if you do it. 5 sessions, they're each over about 1.5 hours of training per session. They're on demand. They were recorded from a live session I did with the first group of people that went through it. You can watch it as many times as you want until you get it. You can watch it at your own pace, whenever you want, day or night. No live classes to attend. You don't have to take a plane or anywhere and book a hotel. You get personalized support. You can follow up with me, any questions after you've watched the sessions. So let me ask you, if you could learn this, and it may change your trading around forever. And I've had people that have gone through other training with other people and they've come to this, and they can now set up their trading that fits them. I had someone that trained with another trader and sat with them for a couple of years, a professional trader, and he was teaching him the way he did it. Again, the strategies that he used to trade every day. And guess what? It didn't fit the pupil, the student. It didn't fit him. He couldn't pull it off. Even though it worked for the trader, it didn't work for him. That's a big problem out there in the world of trading education. You have to, as a trader, stand on your own 2 feet. You need to find something that works for you. So if you can learn a framework and find yourself within that framework, find something that makes sense to you, then you can trade it with confidence. Supply and demand makes sense. Prices rise, why? Let's identify where it is. Trend ends. We're in an uptrend, you want to buy. Where? Pullbacks to demand. How do you identify it? Direction changes to the upside. That's a great place. How do I manage my risk? Where do I put my stop? How do I position size? These things are basics that you need to understand. They're building blocks for launching your own trading career or getting back on track if you're in the kind of loop or spiral of searching for the Holy Grail. There isn't a Holy Grail. It does not exist. There's no special system out there that's going to work for you and be magic and make you tons of money. It doesn't exist. The Holy Grail for trading is within every one of you. Can you do what it takes to become a successful trader? Can you develop your own system based on sound principles of reading the market that will make sense to you? And you will understand them as opposed to green light, red light, and let's buy the next best indicator. Do you want to take the power into your own hands and build it yourself from the ground up? So let me tell you, if you want to do this training, you can join now. The regular price for the training is $4,997, $5,000. But if you purchase, this is a special offer for everyone on this webinar, before Thursday, the 17th, Thursday, August the 17th at midnight Eastern time, you'll get $1,000 off. Now, again, this training's worth much more than that. It's based on over 12 years, day in and day out of trading. Actually, a bit less than that because I actually put the course together over a year ago. I mean, it's actually more than that, but it's in this form, it was over a year ago.